about candlesticks or Japanese candlesticks, whichever you'd prefer. Most of us just call them candlesticks. And they're a form of charting that was developed in the 17th century. They made it to the Western world many centuries later and weren't used all that much because they are a time-consuming charting method. But with the growth of online trading and the advancement in development and computers and Java charts and HTML charts, candlesticks have become the favorite charting type of online traders. Now, each candlestick represents a data set that is the complete price action during that selected time frame. Candlesticks and candlestick charts are no different than any other chart. You can have a 5-minute chart, a 1-hour chart, a 1-day chart, a 1-week chart, and each one of those candles represents whatever time period you've selected your chart for. So if you're looking at a 1-hour chart, that means the open, the high, the low, and the close for that 1 hour is placed on the chart. If you're looking at a bar chart, okay, it's the open, the high, the low, and the close for that 1 hour. If you're looking at a line chart, it's the dot at the close for the 1 hour. The Japanese candlestick also represents the open, the high, the low, and the close for that 1 hour. Now, what we do is, for that time interval, we put a line across on the chart at the open of that 1 hour. Okay. At the close of that 1 hour, we put another line across. We then put a dot at the highest price in that 1 hour and a dot at the lowest price in that 1 hour. And we connect the high and the low to the lines across the open and the close. And these lines that we put on are called wicks or shadows. And then we connect the two lines, the one we drew at the open and the close, onto the chart. And that forms our candlestick. Now, if we stepped down, imagine it's a ladder. If we climb down the ladder from the open to the close, that's a bearish candle. And if we stepped up from the open to the close, that's a bullish candle. And originally, before we had the new Java charts and the HTML charts, we would use black and white candles. Because when you were hand charting and just using a pencil and drawing all your charts directly on the graph paper, whether it was the 17th century and you were trading rice, or in the 20th century and you were trading agriculture or stocks or futures, once you drew all this onto your chart, it was this easier, because it was a time-consuming process. It was easier for, if it was a bearish session, which today is red, that you would just take the side of your pencil and fill it in. And that would become a black candle. So when you hear about black, think of it as equal to red. And when it was a bullish session, you would just leave the outline of a candle there, so you'd have nothing filled in, so it would be white. So a white candle is the same as a green candle. A black candle is the same as a red candle. And the reason this is kind of important, even though today you look at red and white candles, is because a lot of the names for the candlestick positions or patterns are named after the original black and white system. So you have 3 black crows and 3 white soldiers, 3 white soldiers. Okay. Today we could call them 3 green soldiers and 3 red crows, but you don't change the names. And a lot of times you're looking at examples, you're reading literature, and they'll talk about black and white candles. So just remember, it doesn't really matter. You can use orange and pink if you want. As long as you know which one represents bullish and which one represents bearish, you're perfectly fine. Now, what I'm concerned about is, what does the size and the shape of the candle tell you? Now, when we put these on our charts, let me just pop up a live chart here. Too many of us get ourselves wrapped up in the reds and the greens. And look, we're human beings. We are affected by our our minds, our psychology, our perception. And when we see lots of reds, it tells us to sell. And we see lots of greens, it's telling us to buy. Okay. But that's not the case for candlesticks. Candlesticks have very little to do with the reds and the greens. They have to do with the size and the shape of the candle. Now, the chart I have up on the screen for you, actually, I reversed the reds and the greens as a little test. Because what we have here is we have a very important pattern. We have a very important trend line, and we have a very important price move, but I've reversed the reds and the greens. So when you see the reds, it's telling you sell, sell, sell. But in actuality, it's a buy, 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 because we're not reacting to the reds and the greens. We should be reacting to the candlesticks, the shapes, and the sizes of those candles. So let me get it back to the correct colors. So we have it in the right direction. Okay, so now, as you can see, we have it in green, green, green. But the greens don't tell you anything. Okay, it is the shape and the size of the candle. And like I said, the preceding, the candle before and the candle afterward, and how those candles are reacting in relationship to the trend. So let's go back to my PowerPoint. We'll explain this a little bit to you. Okay, so the first thing that a candle tells you in a general scenario or generalized terms, it tells you about the battle of the bulls and the bears. Because this is very, very, very important. Who is controlling the session? That 1 hour, if you have a 1 hour candle, or the 1 day or 4 hour candle, whichever you selected, who was in control? And that is a vital piece of information. So there are really 6 different stories you can tell. The first story you see on the candle is a long or normal body size with a small wick up or down. What does that tell you? It tells you the bears were in control of the session. The bulls were in control of the session. The bears had a little bit of a somewhere, we don't know where in the process, but somewhere in that time frame, because they were able to get the little tail down to make a low. And the bears and the bulls were a little bit stronger because they were able to jump up a wee little bit, but the candle overall closed higher than the open and a sizable amount, and showed you that the bulls were in control for most of that session. And at the end of that session, they were still in domination. The opposite is with the next candle. It's the bears that were in control. In example number 3, we have small bodied candles. That means the open and the close were relatively close to the same. There was very little movement, okay, in that session. That tells you there was a lot of indecisiveness. And nobody was in control. 4, 5, and 6 are also small bodied candles. But in one case, in 4, we see at some point the bears dominated. They pulled that price all the way down, but they weren't able to hold on to it. And the price ended up closing pretty close to where it opened. Reverse that story and you have number 5. And in number 6, we had a big tug of war back and forth, but at the end of the session, nobody ended up claiming victory. And that's an important thing. Now, From there, we go on to specific types of candles that tell you something. But I've got a short little presentation prepared for you. And let me run that, and then we'll come back and talk about the different types of candles and what they mean. So as you can see, candlesticks are not that complicated. In fact, they can be used in very simple trading methods. The fact is, you have to learn the different candlesticks, what they mean, what they're trying to tell you, and then the patterns. Now, I've given you a cheat sheet and 3 different documents, the number of candles explained, and the top candlestick patterns and the second level candlestick patterns. Because ultimately, there are 32 different candlestick patterns that are trying to tell you something. Now, we talked about bearish engulfing and bullish engulfing in the little presentation. We talked about dojis, we talked about evening stars and morning stars, but there are some basic candlestick formations that also are significant to us. One of the most common and one of the most talked about is the Marabuzu. The Marabuzu is on my screen right here, and you can notice right away that there's something unique about the Marabuzu. Can you see what it is? It's got no wicks or shadows. What that's telling you is in that session that the bulls, when it's a green candle, when the bulls started out, they dominated. The bears had no say in that entire session. There was never a low, and the price rose all the way and closed at its highest level, and that's why there's no high. So there's no wicks. That's telling you the bulls are in complete domination. Whereas in the red candle, the red Marabuzu, is telling us the exact opposite scenario. It's telling us that the bears were completely in control. Now, as with all candlestick patterns, we need to see where this pattern or this candlestick appears in relationship to the trend. Because even though it might appear and be a beautiful candlestick, if it doesn't appear within the proper trend in the proper direction, it's not telling you anything. So we have spinning tops. Now, spinning tops look similar to those that I showed you in the fight between the bulls and the bears. They're candlesticks with long upper and lower shadows and no real body. And then we have doji, which we talked about a bit in the video and the presentation. A doji appears quite often and is important, especially when it appears on a trend line or in conjunction with other candles before and after it. A doji tells you that there is a sense of total indecision in the marketplace. Now, the original definition of a doji was, I don't know what's going on with my markers here tonight. I don't even know what just happened with my presentation. I'm sorry, something's happening with my mouse. I think the battery's going dead. A doji used to be defined only by the opening and closing price needed to be identical. And therefore, you'd have a little straight line across. You'd have no body at all. But that was years before we had computerized online trading, having nothing to do with online traders. It happened to do with especially Forex trading that became very large because we're trading in pips, 4 decimals over to the right. You know, when dojis were adapted to the financial markets, okay, it was mostly stocks that moved slow. And, you know, if the stock opened at $100 and closed at $100, okay, maybe that stock only traded in 25-cent increments. So it opened at $100 and 100, went up to $100.25, closed at $100. That was quite often. Okay. And you'd have no difference between open and close. When you're using numbers 4-digit over to the right. So you're talking about the euro trading at 1.3151 and it closed at 1.3152. That's 1,000th of a point difference. So the dojis will reinterpret that they can have very, very small bodies. Okay. And they still tell you total insignificance in the market. Now we have dojis that have equi wicks up and above and below. And then we have dojis that have very, very long bodies. Okay. But again, we always want to be looking where a doji appears in relationship to the trend. Now that you've had some basic idea of what candles indicate with their bodies and wicks, let's cut our teeth on some uncomplicated candlestick patterns. These are fairly common and quite likely to appear before you in a normal trading session. So knowing instantly what they mean and taking the proper trading decision immediately could make the difference between a winning and losing trade. So we have our standalone positions, which are like a star, which looks like the price broke above where it opened, and it looks like the new candle sitting out there above or below. But because, especially in Forex market, we can't have gaps, but they look like they gapped away. And then we have hammers and inverted hammers and shooting stars, and we have hanging men. You're not going to learn them in one class. You're not going to learn them in one night. That's why I gave them to you in the handout. You can look at them, read what they mean, understand what they're trying to tell you in the marketplace. And then we have one of my favorites, a Hammurabi. Okay, a harami. You know it's getting late. Okay, a harami means pregnant in Japan. So the newest candle must be fully contained within the body of the previous candle, not the wicks of the old candle, but the entire new candle, including the wicks, must be inside the body. So imagine as a pregnant animal or a pregnant person, the hands and legs, feet, and everything have to be inside the body of the mother, not something coming out the mouth and something coming down the ankles. Everything is contained in. Now, it doesn't matter if the new candle is the same color or the opposite color of the previous candle. What we're looking for is a small, it doesn't even need to be a small body candle. It needs to just be simply fully contained within the body of the previous candle. A harami is one of the most common candlestick patterns you'll come across. So it's important to recognize it, to understand what it means, and to understand its limitations. A harami is a 2-session reversal pattern. Remember in the demonstration, we were showing you reversal patterns. It's made up of 2 candlesticks and implies that the price is about to turn. It is indicated by a small body of the opposite color completely contained in the body of the previous session. It is not essential for the 2 candles to be of opposite colors, but this tends to give the signal more validity. Now, I'll be blunt with you. A harami doesn't always live up to its hype. While it is touted as a reversal indicator, you may find yourself disappointed by its reliabilities. Okay, but if you look at it in connection to the trend, it's a very reliable signal, especially if you have opposite colors. Now, I define my harami by very specific rules. And the more specific and the tighter the rules are, like I always look for opposite colors. So we've talked about dojis and haramis. We've talked about marabuzus. We've talked about formation and the explanation of shapes and sizes. I'm reading it. But now it's time to learn about multiple candlestick patterns. Now tonight, we're not going to have the time to go over them all, but they're in those handouts I gave you and on that cheat sheet. So we've talked about the singles. Now this chart that's up here, I didn't come up with it. I think I got it off of Daily Forex or somewhere like that. Okay. Now, I only call them singles, doubles, and triples. Here they've given some cutie names like Lonesome Cowboys, 2 for Tango, 3 Musketeers, but it's 1 candle, 2 candle, and 3 candle patterns. We've talked about the Marabuza, the spinning top, the doji, the hammer, the hanging man. We mentioned in the video, in the presentation, the bullish engulfing and the bearish engulfing. Okay. And then we have the triple candles, the morning star, evening star, white, 3 white soldiers, 3 black crows. Those are the ones I mentioned much earlier too, that today they should be 3 green soldiers and 3 red crows, but we never changed the names of them. But remember, there are 16 major candlestick patterns. And of those, and there's a total of 32. So you have bullish and bearish engulfing, which we demonstrated in the presentation to you. Now, by this point, you're ready to scream, how am I going to remember all this? How am I going to deal with this? How am I going to trade with this? Well, first of all, let me pop you up some live charts here. And I'm going to show you some easy techniques. Okay, here's our gold chart, as soon as it pops up on your screen. And almost every charting service will give you a way to put these patterns directly on your charts. Here we're going to go over to scripts in the library. I'm going to come down here and look for candlestick patterns identified. I'm going to click on it, and lo and behold, look at my chart. All the candlestick patterns that have happened in that chart are identified and pointed out to me on the chart. Okay. Now, the fact is, we can go one step farther and go to format and pick out the candlesticks that are important to us. By, you decide which ones you want to trade. If you just want to look at bullish engulfing and bearish engulfing, you can pick on which ones you want to see, which ones you don't want to see, and reduce them off your charts. You can also decide how you want them noted, what colors you want, how you want the bars to show, So if you want all of these to be in black and white, or to, just to give them to you in reds and blues, you decide, and then it's set up on your charts, and you just see the patterns that you're interested in as they appear on your charts. And if you're not using these charts and you got, set up on trading, you can copy it over to the chart you're using. Once you've seen where it is, all the charts are going to be identically the same. So here we see that we have a bullish engulfing pattern. Right here. And what's a bullish engulfing? The current candle fully contains the previous candle and trades as high as the highest it was over here. So as you can see, the last 2 price moves are fully contained within this candle of the opposite color. So we had a downtrend moving here. We had 2 red candles, and then we get a green candle, a bullish candle, which fully engulfs the previous 2 moves downward. That tells us price is about to reverse and move up. We don't know how high it's going to move up, but it tells you it's going to reverse. And this is most likely just then simply a retracement. Push, ease, and the price will continue to move upward. But this helps us simplify putting the candlestick and seeing the patterns on our charts. But there's other ways to incorporate candlesticks into your trading and your charts, because candlesticks help you visualize price movement and helps you see patterns and prices fairly easily. Now, so it's made it a little bit easier, but remember, each candlestick is simply a reflection of market sentiment. It's not just the standard patterns, but with keen observation, You can master the art of trading by looking at charts, even without remembering the names of the patterns. Now, there are many ways to trade with Japanese candlesticks. The best is in combinations with other indicators such as pivot points, support and resistance, and volume. And you can trade with candlesticks only. I can only give you a set of guidelines and rules that I follow. Now, I'm going to show you another presentation that's going to show you an easy method of incorporating or using candlesticks into your trading without ever having to even see the patterns that are developing. So let me pop this up on your screen. So as you can see, there are many different ways to trade with candlesticks. I'm going to show you one other method that could be quite interesting and help you in your use of candlesticks with your trading in a unique way. So that's another way that you can look at candlesticks. So as you can see, there's many different ways you can apply candlesticks to your trading. But remember, it's best in combination with other indicators. Always look at trend lines, understand the patterns. Don't get yourself into the red and green psychological mess of thinking lots of red just means sell. Okay. Look at the size, the shape, the length of the body, the wicks. Understand the story the candlesticks are telling you, and then incorporate it into your trading. Thank you very much for supporting us tonight. Thank you for visiting Alvexo. And if you go to www.alvexo.com, our presenters for tonight, you can sign up for a demo account. There's no credit card required. And they have lots of education materials as well as advanced charts, as well as they'll hook you up with a financial analyst who will explain to you one-on-one candlesticks. And you can watch and read all of their ebooks and watch all their videos on candlesticks. And then you'll find you'll master candlesticks in no time. Thank you very much for joining us and have a great evening now. Bye now.